everyone. Manong Desai with Malabar Hill Capital here with Dr. Raj Venkatramani. Webinar that we put some time to thinking about, which would be helpful for a lot of people. Due diligence for passive investors, selecting the right commercial real estate sponsor and developer. With that, let me introduce Dr. Raj Venkatramani, a very good friend. We met about 2 years ago. Being in the real estate space, but particularly being in Houston. Dr. Raj, he's an oncologist, real estate investor, entrepreneur, founder, and manager at REI Capital LLC. Raj went to medical school in India and trained in London, Illinois, and California. Dr. Raj also carries a master's degree from the University of Southern California and an MBA from the University of Massachusetts. Dr. Raj, he owns and manages several rental properties in Houston and has invested in multifamily syndications for more than 7 years. He's also invested not only as a limited partner, but as well as a general partner in more than 2,000 apartment units. And he also is the founder of REI IDOC agency that helps real estate investors automate their capital raising efforts. And in fact, Malabar Hill Capital also through that agency uses Dr. Raj's CRM, which has been instrumental in getting out to our investors information. Thank you, Dr. Raj, for joining us.
Thanks for inviting me. I'm very happy to be here.
Well, this is an interesting time, real estate. It's a very dynamic time. I think that high net worth individuals, physicians like ourselves, are always looking for alternative investments. I've always been interested in alternative investments, really to kind of round out our portfolio. And we have to look to sponsors. I have been a limited partner in real estate, much like yourself. But now that we're sponsors, maybe a little bit about your experience, because I know you run a fund of funds. I'm a developer and a sponsor. But go ahead.
Sure. I could bring a different perspective to this conversation. I'm mainly in multifamily space. Dr. Desai is actually building, and he's a developer and he's building new buildings. When I look at from multifamily space, especially the first question there is like, how do you look for a sponsor? Of course, over time, I've changed my perspective on it through some mistakes and experiences. So sponsor, of course, when I look for a sponsor for a multifamily apartment syndication, the first thing I'm looking for is experience of the sponsor. Right? How long have they been in this space? How many full cycles they've had? Not only experience in real estate, I also want them to have some real life experience. What they meant is, of course, a 21-year-old can be a very talented person, but I'm not going to let a 21-year-old run a $60 million apartment, right? They need to have some real life experience managing teams, managing people, managing assets, those kinds of things. So those are the things I'm looking for, is not only experience in real estate, having gone full cycles, real life experience managing big teams or businesses. I'm also looking for what is the background. Like most people don't start out straight away saying, this is my career path, I'm going to do real estate syndication. Some of them have been engineers, doctors, or other professionals, then or run small businesses, then come to this space. So I'm looking for all those like a 360-degree their background before I go with a certain sponsor. So that is the first thing I'm looking for.
Yeah, I think you hit the nail on the head when it comes to experience. What experience tells you is what your strengths are, what your weaknesses are, what you do want to do, what you don't want to do. When we were tackling, my partner and I were trying to develop Malabar Hill, and what asset classes that we were going to develop, greenfield projects. He and I have both come from the operational space, I having run acute care facilities, physician practices, and having done medical real estate development. And while those were all very fulfilling, very heavy operationally, and my partner is a pure developer, having done hospitality and climate control storage, very operational heavy. And that's why we came to doing a specific real estate class that we could take out of the ground, but on the back end was not as operationally intensive. And why I bring that up is because, asking the sponsor why a specific asset class, are they comfortable with it? Can they take it full cycle? I think you bring up some very good points. Details on past projects, successes and failures. I think oftentimes we like to think of our our successes, but I think learning from your failures is super important as well. Whether that was asset specific or macroeconomic, multifamily, I think is a very good asset class, but it's tough to perform in this market, and that's more macroeconomic versus oftentimes within the asset class itself. What's your thoughts about that?
So exactly. So failure, I think no one can be 100% successful, right? So, but what they learn from their failures, for example, you just mentioned you can do everything right. You can do the proper management. You can do everything right, but still may not make money in a specific project. That may be because of the overall macroeconomic environment. For example, now you may be hitting the NOI target very well every year, but if you're now forced to sell your apartment right now because the cap rate, which you don't control, is expanded so much, you're not going to make money. So it may not be the sponsor's fault that the specific project did not make money, but what did they learn from it? So that's what you're basically trying to find out. And often when you go to these presentations, they'll say, hey, my last 30 projects made 25% IRR, or whatever it is, the average of. But sponsors are often reluctant to show people the project which failed, right? So you have to ask them. No one in the webinar says, my last project failed, right? Because they are worried that, people may not invest. So we had to specifically ask them, hey, why it failed? What did you learn from it? And that actually provides often more insights. Sometimes it's even dangerous if they say, hey, I never had a project fail, because they probably did all their projects during the upcycle of real estate between like 2019 and 2021. And then no one, you don't have to do anything. You just buy a property, natural increase in price, you made money. Then those sponsors may not actually know how to perform when there is a down market. So you ideally want someone who has gone through up market and down market. Then they have more experience. They know how to handle stuff, and they know how to de-risk their project for those down market stuff as well.
Very good point. I mean, it's oftentimes, and we'll talk about it a little bit more on financial projections and what have you, but intimately knowing your asset class and stress testing models will kind of open up your eyes to that as well. But that's where I think experience comes in as well.
Yep. Mm-hmm.
Financial stability and transparency. As a sponsor myself, and also a limited partner, I'm one that understands financial statements, and giving it to limited partners, I think, is really important. I think sophisticated and accredited investors are more and more understanding the financial statements, as it relates specifically to the asset class we're developing. So we're not necessarily cash flowing entities at the beginning, but cash flowing entities, much like multifamily, looks a little bit different, as well as understanding the capital structure and getting very comfortable with that terminology: senior debt, preferred equity, junior debt, and then of course common equity. Any thoughts on those first two questions?
I always insist on transparency, but now sometimes sponsors think sending 100-page P&L rent roll, they meet their obligation by sending that. But I always insist on, hey, what is your interpretation of this report? Put a letter in front of the report, because often my limited partners don't have time to review. They have invested in 10 different properties. They're not going to sit down and go through the rent roll, the P&L, and whether we're meeting budget projections, those kinds of things. Sometimes sponsors tend to hide behind those 100-page report and saying, hey, I did my job, I sent this thing, right? So I always say, hey, what is your interpretation? What do you think about the trend? What are you expecting in the next 6 months? So put all those things in the actual letter. And I also insist on, if it's a bad news, don't try to hide the bad news, right? So say we're not meeting our projections, the rent in this area is not increasing as we projected. We need to tell the limited partners ahead of time so they can anticipate that. And most limited partners are forgiving if you're very transparent and say, hey, these are the things we are doing. These are the things which are not working according to plan. But sometimes sponsors have this reluctance to give bad news. They try to avoid it as long as possible. And suddenly one day they say, oh my God, the sky is falling. So transparency is important, but not only just sending all the financial statements, interpreting that for the LPs. What does the sponsor think? What's going well? What's not going well? If something is not going well, what are we doing to turn the situation around? So that is very important.
Yeah, I think that's good contextualizing it is that there's almost like a story behind every asset and being able to articulate that story, kind of in a running dialogue as it would be for each asset. Um, Diversification is important between cash flowing assets, developments that we do. A lot of people do, storage and there's a different type of a story behind each one of those, and to be able to articulate that. And of course, it changes in the life cycle of the asset. The handling cost overruns and unexpected financial challenges. I think I mentioned to you, and I oftentimes tell investors, is that in development, um, hurdles are the norm. It's not the other way around. And so when we're doing our construction loans, we have to put so much contingency, and we have to anticipate. And I always start off in my financial performance with what does it look like to for zero return, and then your base case returns and your best, and and looking at a risk model of no return whatsoever. And I know that people don't want to hear that, but I think it's as important to no return and loss of equity. And if people understand that we're stress testing our models, now in the development world, we have a little bit more latitude because almost a 200 basis point spread. But I think also understanding that the general partner has the bandwidth to, and whether it be interest carry or cover cost overruns. Thoughts on this?
Sure. So, other important point is a lot of the sponsors, not, of course, there are very good sponsors, bad sponsors. Some of them are very good at marketing, but the essential quality is they need to understand finance as well, right? So this is, at the end of the day, they're running a business. They're very good at marketing, raising capital, but once the capital comes in, they have to use it properly, and they need to know how to manage the finances. So it's very, very important for them to have this understanding of that. And also, at least in multifamily, it's very, very important to have reserves, enough reserves to overcome any kind of unexpected situation. A lot of times, in order to boost the return, or at least the numbers, the sponsors don't raise enough reserves. And that often leads the property to trouble, because there is some decrease in occupancy, then you're not able to pay the mortgage and you're at risk of losing the whole thing. So that's where financial acumen comes in. They need to plan for it. They need to raise enough reserves. And people are often laser focused on the IRR number. And of course, sponsors and LPs both are to blame here, because sponsors always want to hire IRR. LPs say, oh, well, high IRR should be good. But you have to, again, they're coming to de-risking. So you have to have enough reserves. You have to have enough financial knowledge to manage this property. That's very, very important.
Yeah, I think that, you and I both have gone to business school. And I think the first thing we hear about in finance is, and I think this is very important, particularly if you don't have a finance or a business background, is IRR, which basically is an interest rate, is a proxy for risk. So if you see 20 or 30 different syndications for the same asset class, and you see outsized returns on a specific syndication, you really need to ask the hard questions, because asset classes basically perform the exact same way. I mean, there's going to be pockets and geographies where there's outsized returns related to risk, but that's not always the case. I know you've invested throughout the Sun Belt area as well as now in the North. What are your thoughts toward that as well?
Yeah, so I believe in the free market, right? Free market corrects for risk, right?
Mm-hmm.
So the different asset classes, there is a standard risk involved. So that's why the returns are like that. So
Mm-hmm.
now, I don't think anyone, there may be exceptional cases, but no one has enough inherent advantage for them to give you like 5 points above what that asset class is otherwise giving. So always question that. Say, hey, so for example, multifamily typical returns you're expecting is about 15% IRR. That's the typical. Someone says, I'm going to give 25% IRR. You need to say, hey, because the way we bid for the apartments, the way the projects come about is we go and bid for the apartments.
Mm-hmm.
And then if bidding $10, get $25. $12 million for the same apartment because they are happy with 15% IRR, right? So there is no one has, of course, some people may be very good at managing the apartment, but typically the return should be around the same mark. If it is very high, then you have to question what your assumptions are. Are you assuming something which other people are assuming? Are you, because it's all in an Excel file, the numbers you put in is going to, a small change in the number is going to boost your IRR. So you have to ask the hard questions to people saying, hey, what is that you have, which all these other hundreds of people don't have? Why are you able to boost this return more than other people?
Yeah, I mean, I often get that question, and for example, our asset class is basically about a 1.9 to 2x return on equity in a 3 to 4 year period. It's very hard to get outsized. Sometimes it'll be 21% or 22%. But again, there's not a spread of 5% in either direction. And in all honesty, when we underwrite, we want to peg that number. Like, I would also ask if, particularly a sponsor comes back and says, here's my track record, and there's going to be 4x on some deals and 0 on other deals. Because then I would ask, like, what made them pick certain asset classes to create such a variability in their returns? My greatest hope is that every asset that we deliver to and yield is exactly the same yield as we said it was. It's not outsized, it's not under. Sponsor team and network. I think that's super important. I've done a fair amount of private equity work, and the one thing we look at it for every company is exactly what the team composition is and their background, and how are they supported, whether it's their legal teams or accounting teams or bookkeepers in-house, and of course their skill set at finance or being a sponsor. What's your thoughts about that? You've seen a lot of sponsors also.
Yeah, and I worked with various teams. So the basic thing is, at least for these big projects, it's not a single person who is running the project. It has to be a team, because one person doesn't have enough skills. It's like we are in medicine, right? So each patient, there is a team of people helping the patient. Similar to that for a real estate thing, someone may be very good at the financial stuff. Someone may be very good at communication. Someone may be very good at raising money. Someone may be very good at asset management. We all come together to manage the property. So we have to see whether the sponsors, there are like 4, 5, 3, 2, whatever it is, whether they possess complementary skills which they are bringing to this deal so that they can make the deal successful, right? You always need a very good asset manager, right? Otherwise, it's at least on the multifamily side. Otherwise, the project is not going to be successful. You can buy it at a very good price and everything, but if asset management is not good, then it's not good. So you have to see who is the guy who's managing assets. How much experience do they have? Have they managed other assets similar to this kind of thing? Who is the main sponsor guy? How much experience are? Who is doing the rehab thing, or how much experience? You have to look at all those things, because that determines the success of the project, especially in multifamily. Asset management is very key. So you have to see what kind of team. If all the people in the team have the same skills, then it's not going to be, you need to have complementary skills for the projects to be successful.
Yeah, I mean, personal experience for myself is that, when I partnered with whom I partnered now, he's done a variety of asset classes, and much just as you said, performed in those asset classes in the up times and the bad times. But he himself will be the first to tell you, you have to have good teams, whether it's your GCs, as associated with your subs or your architect and engineers in our circumstance because of development, accounting teams, and also those internal processes of reporting and regular meetings and project management, because ultimately to perform on time and for the asset to be able to perform, all of those things have to be in sync. And one thing we always, particularly when we're bidding out for GCs or architects or what have you, is we always say, like, we don't want anyone to learn on our time, right? So you don't want to be investing in teams that are learning on your dime, right? And I think that's what we're really trying to come across and say is, like, if you're investing, invest with the team that knows the most and can also perform the best, right? Um, Last thing we wanted to kind of bring up is sponsor communication. It's something that my limited partners oftentimes, now I allow myself to be kind of readily available even on my cell phone. I do most of the investor relations. That seems to work well. But I think in a perfect world, the transparency of quarterly updates or monthly updates. And then of course, P&L sheets, those type of reporting. We put that on our investor platforms annually along with the K1s. We're of course in development where from a month to month, there's not a whole lot of change on our assets. How about your experience with your investors on cash flowing assets?
So for multifamily, our typical reporting is every month. We kind of talked about reporting. There is reporting and there is reporting, right? So it has to be actionable or useful for the LPs when you report. So that's key. But every month, but I think for cash flowing assets, the minimum should be every quarter.
Mhm.
You should have reporting along with your financial statements, bank statements, et cetera, et cetera. And then, of course, there should be some forward-looking statements too, like, hey, the occupancy is right now 88. In the next 3 months, we are projecting an occupancy of 94. These are the things we are doing to increase this occupancy. So those are things the LPs are looking for, not just a financial statement, but also some forward-looking statement interpretation. What does the GP, general partners, think how the asset is doing, and what are they doing to make it better? Right. So that's what we try to do in our communication. Minimum is every quarter, but usually try to do every month.
Yeah, 100%. How about investor queries and concerns and how are they handled? I personally handle on a one-to-one basis. If I hear the kind of same sentiment for the investors, particularly
Sure.
all of our projects are specific LLCs, so we're not like a fund per se. We'll reach out to the investor group. Typically, like I said, most people are on a one-to-one basis. But how about yourself?
Yeah, ours is not a very large company yet.
Mhm.
So I have about 100 investors. So all of them I know personally, and they all have my cell phone number, and they can call me anytime they want. So for me, it's also one-to-one. Of course, I can understand if some company has thousands of investors, it's difficult to be a one-to-one. Then they have investor relations person, those kinds of stuff. We don't currently have I'm the investor relations person, and I like talking to my investors directly, and I like responding on time. Right? Whether it's weekend or weekdays, I still respond to text or calls. But I don't blame for big institution. If the company is very big, they may not be able to do it. They may have like Monday to Friday, 8 to 5 hours, and those kinds of things. For most of my investors, that doesn't work because they're all physicians. They're working during the daytime, so the only time they have is weekends or evenings. So I'm available those times to talk to them.
Perfect. Yeah, I think knowing your customer as it would be, right? And so I sit in the same boat as a physician. A lot of our investors are physicians as well. So they're going to be, per se, off hours. Well, Dr. Raj, I really appreciate it. I hope this webinar is helpful. Our contact information is above Manong at mhcapital.org. Dr. Venkatramani is at Raj at rei.capital.com. Again, I think our biggest role as sponsors is also education. And I think if people feel comfortable with what they're investing in or they're educated, take the time, don't blindly invest. But that's how I take on my role. Feel my role is greatest helpful to investors. How about yourself, Dr. Raj?
Yeah, thank you, Dr. Desai, for having me on. So as you know, I've known Dr. Desai for a couple of years, and then it took a couple of years before I actually invested in one of his projects. So I actually invested in his business model is great, and it's local. So I'm able to visit the property here in Houston. So yeah, I actually have brought along my own investors to Malabar Hill Capital as well. So I trust his projects, and yeah, reach out to me. We do multifamily. Of course, we have invested in we do new development multifamily as well, and we are doing strip malls. We're looking for the asset classes as well. So reach out to me anytime if you guys want to learn more about our company.
Appreciate the support. Thank you. And thanks, everybody.